place your stop loss at what seems like the perfect spot. Support level, previous low, textbook risk management. Then you watch in horror as price drops exactly to your stop, triggers your exit, and immediately reverses back in your favor. You just got stop hunted, and it wasn't random. Somewhere in a glass tower, institutional traders are laughing while your money flows into their accounts. The brutal truth is that 90% of retail traders place their stops in the exact same predictable locations, creating a feeding frenzy for smart money who know exactly where to find easy liquidity. What I'm about to reveal will either transform you into a predator who profits from stop hunts, or you'll keep being prey and wonder why every perfect setup fails at your exact stop loss level. The liquidity map. Institutional traders don't see support and resistance the way you do. While you're drawing pretty lines on your charts and placing stops just below obvious levels, they're seeing a detailed map of where millions of retail orders are clustered. Every stop loss below support represents guaranteed liquidity they can harvest. Every protective stop above resistance is money waiting to be collected. They know exactly where your stops are because you're placing them in the most obvious locations every trading book teaches. Large institutions need massive liquidity to fill their multi-million-dollar positions. When a hedge fund wants to buy $500 million worth of euro-dollar, they can't just hit the market buy button like you can with your $1,000 position. They need to find someone willing to sell them that much currency, and retail stop losses provide the perfect liquidity source. Your protective stop becomes the guaranteed counterparty. They push price down to trigger your stop, collect your shares at a discount, then let price return to fair value while you sit on the sidelines wondering what just happened. The mathematics are brutally simple. If 80% of retail traders place their stops just below the previous swing low, smart money knows they can trigger billions of dollars in selling pressure by pushing price down just a few pips below that level. Your individual stop loss might only be 500, but when multiplied by hundreds of thousands of retail traders using the same strategy, it becomes a massive liquidity pool. The institutions aren't trying to hurt you personally. They're simply harvesting the predictable behavior patterns of amateur traders who all learned from the same textbooks. Stop-loss clusters create price magnets that smart money can't resist. When massive amounts of sell orders are sitting just below an obvious support level, institutions will push price down to trigger those orders, creating temporary selling pressure that drives price even lower. This cascading effect can turn a minor pullback into a significant move that wipes out thousands of retail positions. The cruel irony is that your risk management strategy becomes the exact tool used to extract money from your account. Understanding this dynamic changes everything about how you view the market. Those sudden spikes that hit your stop and reverse aren't market manipulation or bad luck. They're the natural result of predictable order flow patterns that smart money exploits systematically. The faster you accept that your stop placement is part of a larger strategic game, the sooner you can start playing offense instead of defense. But knowing where the traps are set is only half the battle. How smart money engineer the perfect stop hunt. Smart money doesn't just randomly push price around hoping to hit stops. They use sophisticated algorithms to analyze order flow data and identify exactly where retail stops are clustered. High-frequency trading firms pay millions for millisecond advantages and order book data that shows them precisely where your protective stops are waiting. They can see the depth of stop orders below each support level and calculate exactly how much capital they need to trigger a cascading liquidation event. The engineering of a stop hunt begins hours or even days before execution. Institutional traders will slowly accumulate positions in the opposite direction of where they plan to hunt stops. If they're planning to hunt stops below support, they'll quietly build long positions while retail traders are still bullish. When they're ready to execute, they'll release coordinated selling pressure designed to push price just far enough to trigger maximum stop-loss orders without creating genuine technical damage to their longer-term bullish thesis. Price action becomes a surgical instrument for extracting retail money. Watch how price behaves around obvious support levels. Instead of bouncing cleanly off support like textbooks suggest, price will often penetrate just far enough to trigger retail stops before snapping back aggressively. The penetration isn't deep enough to constitute a real technical breakdown, but it's precise enough to harvest retail liquidity. Professional traders call these moves stop sweeps because they literally sweep up retail orders in a systematic fashion. The timing of stop hunts follows predictable patterns that amateur traders rarely notice. Hunts often occur during low volume periods when fewer genuine market participants are active. Asian session reversals, Sunday night gaps, and pre-market moves are favorite hunting grounds because retail traders have less ability to respond quickly. Smart money can move price more efficiently when there's less genuine buying or selling pressure to counteract their liquidity harvesting operations. They're not fighting market sentiment, they're exploiting market mechanics. Volume analysis reveals the mechanical nature of stop hunts versus genuine market moves. When price hits your stop and immediately reverses, check the volume profile. Stop hunts typically show volume spikes at the exact turning point where retail orders were triggered, followed by lower volume as price returns to fair value. Genuine breakdowns or breakouts show sustained volume as real market participants continue trading in the direction of the move. Learning to read these volume signatures helps you distinguish between profit-taking opportunities and genuine directional moves. Once you understand their playbook, you can start writing your own. Weaponizing stop hunt psychology. The most profitable traders don't avoid stop hunts. They position themselves to profit from them. Instead of placing stops where everyone else does, they identify where retail stops are clustered and prepare to take the opposite side when price reaches those levels. When you see price approaching a level where thousands of retail stops are waiting, you're looking at a high probability reversal opportunity. The key is having the courage to buy when retail traders are being forced to sell, and sell when retail traders are being forced to buy. Stop hunt reversals offer some of the best risk to reward ratios in trading because you can use the retail stop cluster as your actual stop loss level. If price pushes through the retail stop area and continues moving, you know the move is genuine and you can exit quickly. But if price reverses from the retail stop area as expected, you can ride the bounce back to fair value with a tight stop and substantial profit potential. You're essentially betting on mean reversion while using retail traders' predictable behavior as your edge. Trading stop hunts successfully requires a complete psychological transformation. While retail traders fear sudden price moves against their positions, professional traders see these moves as profit opportunities. When price spikes against the crowd, amateurs panic and hit their stops. Professionals recognize the spike as artificial price manipulation and prepare to fade the move. This psychological reversal is what separates consistent winners from consistent losers in the Forex market. The fear of being stopped out prevents most traders from taking advantage of stop hunt opportunities. They see price approaching their stop level and either move their stop further away or close the position early, both of which destroy their edge. Professional traders understand that stops exist to be hit occasionally, and they factor stop losses into their overall strategy rather than treating each one as a personal failure. They know that trading against retail sentiment means accepting short-term pain for long-term profitability. Emotional control becomes your greatest weapon when trading stop hunts because you're deliberately entering positions when price action looks terrifying. Buying when price is falling aggressively or selling when price is spiking requires the ability to override your natural risk aversion instincts. Most traders can't psychologically handle taking positions against violent price moves, which is exactly why stop hunt reversals are so profitable. Your willingness to act when others are paralyzed by fear creates your competitive advantage. Risk management with stop hunt strategies requires different rules than traditional trading approaches. Since you're positioning against momentum, you need to be prepared for immediate drawdowns and have the discipline to hold positions through temporary adverse moves. Professional stop hunt traders often use time-based exits rather than price-based stops, giving their positions room to work while retail panic subsides. They understand that profitable mean reversion takes time and patience rather than immediate gratification. The ultimate psychological edge comes from understanding that you're not trading against the market. You're trading against other traders' predictable behavioral patterns. When you stop seeing price movements as random events and start recognizing them as the result of human psychology interacting with market mechanics, everything changes. You become a student of mass psychology rather than a victim of price action. Every stop hunt becomes a transfer of wealth from amateur traders who react emotionally to professional traders who understand the game being played. Your choice is simple: learn the rules and profit from them, or remain ignorant and keep funding other people's accounts.